Now, this is an interesting standard. Looks like on the overall, it is in its own class, on its own, even though it has some relationship with other standards like IFRS 2 share based payments, IFRS 9 financial instruments, recognition and measurement, and then IAS 32 financial instrument presentation. So even though it has some relationship with some standards, it's a standard that is on its own that we need to understand in the light of the way it is structured. Now, you need to understand of the bet that when it comes to earnings per share, it's going to be divided into two. So we're going to be looking at this in a two-part presentation or discussion. We're going to be primarily having what we call the basic earnings per share and then the diluted earnings per share. So we're going to be having this in two parts, the basic earnings per share and the diluted earnings per share. When we talk about the basic earnings per share, what I want you to think of is the current earnings per share of the company. Okay, the current earnings per share of the company based on current shareholders. Okay, so how much shareholders are going to be receiving right now in today's term? So basic earnings per share is based on the current shareholders, the current shareholding position of the entity. But then the diluted earnings per share, I want you to think of this as the future earnings per share of the company, technically is the future earnings per share. In other words, it talks about the earnings per share that will be earned by the shareholders potentially in the future. Okay, all potential shareholders, what they are likely to be earning in the future. So we're going to discuss this, like I said, in two folds: basic earnings per share, diluted earnings per share. Like I said, in a simple language, the basic earnings per share, we'll be thinking about that as the current earnings per share, the current shareholders. How much will they earn should we share the profit attributable to the equity shareholders? But the diluted earnings per share is going to be future earnings per share, taking into consideration all potential shareholders of the entity. It is for this reason why there are three sub scenarios under the basic earnings per share we must know about, and that is issue at full market price. We have bonus issue, and then we have right issues. Very, very important. So, under the basic earnings per share, these are three key scenarios that we're going to be getting ourselves into to know about now, because the rules about how we calculate the earnings per share, it's different when it comes to each of these scenarios. In a given question, the examiner may give us all the scenarios in one, or just focusing on one of the scenario or a specific scenario in that regard. Now, in diluted earnings per share, also there are two scenarios there when an entity, gives share options. Okay, the share options could be given to shareholder employees of the company. It could be given to the customers or suppliers of the company. So share option, we're going to get into that, don't worry. And then the second thing is where the entity issues any convertible, loan notes, or what we call convertible financial instruments. So if an entity issues any convertible financial instruments, that could result into the number of shareholders potentially in the future increasing or changing. For that reason, we would have to find out how we can calculate the impact of these on the earnings per share of the entity. And that is very important for us to understand exactly what is going on. Now, when it comes to issues in relation to the convertible earnings per share, convertible financial instruments, it depends. Either the entity issues convertible loan notes as covered in IFRS 9. Okay, maybe the entity is issuing a convertible loan note, or the entity issues convertible preference shares. because there are certain preference shares that can be convertible. So this is how the overall discussion is going to be in relation to IAS 33 earnings per share. The basic, what is currently going on, the diluted, what is likely to happen in the future to the potential shareholders. For this reason, in a simple language, what's going to be happening is that our earnings per share is going to be equal to PATES, and I'm going to explain what PATES is, divided by wins. PATES divided by wins. Now, so what the heck is that? PATES means profit attributable to equity shareholders. Profit attributable to equity shareholders. Now, you have to be careful about this because we are not just looking at the profit for the year. Our focus is on profit attributable to the equity shareholders. So when we take the company, how much profit is attributable to equity shareholders? So somebody will ask, how the heck do we calculate that? So let's go find out how we can calculate a profit attributable to equity shareholders. So for illustration purposes, the profit attributable to equity shareholders will be the profit for the year. Now remember, profit for the year is the same as profit of the tax. Okay, you bring that up. Then you're going to less dividend payments to preference shareholders. Dividend paid to preference shareholders. Because if we have preference shareholders, remember, preference shareholders receive fixed dividend every year, okay, or interest. But the interest we pay on preference share is a liability usually. The interest we pay on preference shares is not brought in the statement of profit or loss. Instead, it is dealt with in the statement of changes in equity. So when we are picking the profit for the year and there is preference shares, then the dividend payable to the preference shares had not been taken into consideration, has not been deducted yet, hence we have to deduct it. Not only that, if we are in a group perspective, then it means that dividend paid to minority or what we call non-controlling interest would be deducted. So dividend paid to non-controlling interest. NIC is non-controlling interest. Now, again, this is a little bit, well, this will really come in for maybe corporate reporting students because that is a little bit advanced for the financial reporting students. But you cannot let anything go because consolidation is in level 2, financial reporting and non-controlling interest is dealt with as well. So I don't want you to take the limit off and say, hey, it's not part. You just have to know if we are supposed to calculate earnings per share in a consolidated financial statement environment, then definitely the dividend that we pay to the non-controlling interest must be deducted because remember, we are looking for PATES, which is the profit attributable to the equity shareholders, the real shareholders, the shareholders of the parent entity. So that will be deducted there. And then boom, that gives us our PATES. Okay, that gives us our PATES. So profit attributable to equity shareholders, that is how we calculate it. That's how we calculate it. Then we go to the next one, and that is going to be the issue relating to wins, the denominator. Now, remember that depending on where we are standing at, usually on the diluted earnings per share, it's likely that the patterns may be adjusted, and we will explain that into detail. We are just talking about the default treatment here. As we take the specific scenarios, as I've indicated here, we may have to adjust the uh, profits attributable to equity shareholders, especially when we are in the diluted earnings per share and we are dealing with convertible loan notes. Because when you are dealing with convertible loan notes, we would have to further adjust the profits attributable to equity shareholders. Don't worry, when we get there, you're going to see how it will play out. Then the denominator is wins. So what the heck is also that? Let's look at that. Wins. Wins is simply weighted average number of equity shares. Weighted average number of equity shares. That's the wins. Now, the reason we go with the weighted average number of equity shares is because we don't just use the number of shares outstanding at the reporting date or at the date that we are calculating the earnings per share. The reason is that the shares may have been issued at different times in the year. So there are a couple of things that you need to understand based on the scenario we are going to be looking out for. Number one, when we are calculating the weighted average number of equity shares, we have to take into consideration the number of periods of outstanding shares. And I'm going to explain this to you, don't worry. Number of periods of outstanding shares is very important. But not only that, we would also take into consideration. Now, note that the number of periods for outstanding shares can be referred to as the timing ratio. Don't worry, I'm going to explain that as well to you, but I want to give you a heads up about it. Then we're going to also have what we call the bonus fraction. Bonus fraction. So when we are calculating the number of equity shares, we have to take into consideration the timing ratio, the number of periods for the outstanding shares, and also the bonus fraction. Now, the concept of bonus fraction will come in especially in two scenarios of the 5 scenarios that I listed together here with the basic earnings per share and the diluted earnings per share. The bonus issue will come in when we are dealing with, sorry, the bonus fraction will come in when we are dealing with bonus issue and then right issues. So anytime there is a question about earnings per share and you see bonus issue, or the entity makes a bonus issue or the entity makes a right issue quickly, you have to note that in the calculation of the weighted average number of equity shares, you have to calculate bonus fraction. And I'm going to explain that to you in a moment. Don't worry about that. So these are the basic introductory issues that we need to understand when it comes to dealing with the earnings per share. When it comes to dealing with the earnings per share. And based on this understanding, we're going to now take the scenarios one after the other. Remember, we listed 5 scenarios here, 3 under basic, 2 under the diluted. We will take them one after the other, share some thought on them, and find out how we can use these principles here to be able to actually calculate the earnings per share of a company, to actually calculate the earnings per share of a company. So let's jump into it. Now, before I get excited to, go into some of the other issues, there are some theoretical discussions that we can get ourselves into and talk about quickly before I go into the calculation. So for those of you with a book on financial reporting or corporate reporting, you can go to IAS 33 earnings per share and you'll be able to see the material there and what has to be covered basically there. Because I'm going to just explain a couple of issues and then we go away in that regard. Whatever I'm going to go through here, I've already spoken about it, but I just want to share a couple of things with you in that regard. So, what is earnings per share? Earnings per share is a measure of the amount of profit earned by a company for each ordinary shares. So, the focus here is on the ordinary shares. The focus here is on the ordinary shares, like I've mentioned earlier. That is why any dividend that we pay to the preference shareholders would have to be excluded from that profit, and we would divide it by the weighted average number of equity shares, the true owners of the company. The true owners of the company. And it is always shown on the face of the statement of profit or loss and other comprehensive income. So if you take the financial statement of any company at all, you will see that below the statement of profit or loss and OCI, you see earnings per share there. And if it happens that they have any scenario that will bring up diluted earnings per share, you will see that they will have also the diluted earnings per share. So it depends on the company, but we will have both earnings per share and diluted earnings per share in that regard. Then why do we have to calculate this? So some importance of this earnings per share issue that we need to understand. Number one, it is a more accurate indication of the profitability of the entity. Because if you remember under ratios, the profitability ratios, uh, the investors ratios, one of the ratios the investors look out for is the earnings per share. How much are they earning on their shares as a company in that regard every year? If is the company more profitable or not profitable? So it shows the profitability of the company. Then it indicates the amount of dividend that the entity is likely to pay. Because again, if you go back to the investors ratio, we mentioned that the dividend per share is expected to be less than the earnings per share. The reason is because of retention of profit. However, the traditional rule is that the more earnings or the more profit the company makes, the more dividend it is likely to pay. So if we are able to calculate the earnings per share and realize that, oh, the earnings per share is increasing year on year, then shareholders will expect that, okay, we are going to also earn more profit, more dividend in this current year or for this year under review. That is the issue about that. Then it is easy to be understood by non-financial experts. I mean, any average person, average investor can understand that earnings per share. That is why it is disclosed directly on the face of the statement of profit or loss and under comprehensive income, so that investors and other users of the financial statement can easily identify it. So that is what we mean by the importance of earnings per share. But as good as it is, it has some limitations. Okay, as good as it sounds, it has some limitations. Number one, it does not take into consideration inflation. Okay, it doesn't consider inflation. So let's say you calculate the earnings per share of a company and you said, oh, the earnings per share is whatever, let's say $1.20. You've calculated it, but you didn't consider inflation. For instance, if you're in Ghana, then you should realize that it depends on whose information you are picking, though. But if you are looking at the Ghana Statistical Service, then you're going to be saying that the inflation of Ghana is 37 point maybe 2. But if you're looking at, I mean, other indicators, it's pecking the inflation rate of Ghana to around 87%. But you know, the earnings per share doesn't consider that. So it just say, oh, this is how much you've earned. But what is the time value of it? It's not considered. That is one of the limitations of the earnings per share. Number two, it is basically based on historical information. So you cannot say, okay, because this year the entity made an earnings per share or had an earnings per share of 1 cedi 20 cents, means that, oh, next year they are likely to have $2 in that regard. $1.20 next year they are going to have $2. It's based on historical information, it's based on past information. So it is not likely for us to use that to predict the future, because the conditions are different, the scenarios are different, the events are different, the accounting policies applied may change in that regard. So yes, it is good, but it is just based on historical information, making it difficult to, make predictions for the future. Number three, earnings per share is directly affected by the adopted accounting policy and estimate of the entity. That is very true, because if the entity wants to manipulate the earnings per share and management wants to have a certain amount of earnings per share, they can change their accounting policies. Instead of, expense treating something as an expenses, do you know what they're going to do? They're going to capitalize it, meaning profit will go up because expenses will be understated and the earnings per share will go up. Maybe depreciation, the asset is supposed to be used for 10 years, but if management want to manipulate that information, what it's going to be doing is that they could increase the estimated useful life to say 15 years or maybe to 20 years. When that happens, less amount of depreciation is charged every year, and the earnings per share figure, it's likely to go up at the end of the day. So it's likely to be manipulated. It will be manipulated by management because of the accounting policies and estimates that they are using. So that is why, even though, yeah, it's a good indication of the earnings of the company, investors don't just rely on the earnings per share to make investment decisions, because management can really use creative accounting and window dressing and all that to be able to manipulate that data there. Then earnings per share. So whilst earnings per share measures the profitability, cash flow can be as important as essential for survival. Now remember, the fact that the company has an earnings per share of $2, or the earnings per share has increased year on year by whatever, let's say 50% or 30%, that doesn't mean that the entity is going to be profitable or has the cash to actually survive. So earnings per share, it doesn't mean the company has money to operate into the foreseeable future. Cash flows is crucial. So if the entity has an earnings per share of say $2 per share, but they have bank overdraft, huge amount of bank overdraft, then where are they going to even pay us dividend from? Because they have bank overdraft. There is no money available. Their current liability is actually increasing, and their liquidity is below one. So where are they going to get the money from? So these are some of the limitations that we can share our thoughts on when it comes to earnings per share. So yes, even though it is good, it's an amazing ratio that we can talk about. It tells us a lot about the company. It also has a couple of limitations. That is what you need to understand fundamentally when it comes to dealing with earnings per share. Earnings per share. Any questions, please? I see some of you guys joining. You are welcome. We are continuing with our IFRS masterclass, and today we are focusing on IAS 33 earnings per share. I see some of you guys joining. Give us a thumbs up on the video. It really helps us a lot to let the video be pushed so we can reach as many students as possible. Let me hear from you also in the comment section or the chat box. Any questions that you have for me, something you would want me to share my thought on. You can also share the video. Let's reach as many students as possible so that we can together, transform the lives of many around the continent and around the globe generally. If you have not subscribed also, what are you waiting for? Make sure you subscribe and click the bell icon. I'm seeing some chats coming in. Let's see if I can take it real quick. Kendrick Siame said, joining from ZM. Which one is ZM? I don't know ZM. Ebenezer Mensa with an emoji. Bright Jikunu also with an emoji. Silence Dodu said forwards and futures. Uh, I don't understand that. Maybe give me some perspective. Adriana Coffee with an emoji thumbs up. Thank you, Adrian. Akariza Fofo said hello. Hi, Akariza Fofo. Thanks for joining us on the stream. If there are any questions, you put it in the chat for me, and I'm going to be providing with some answers here. And also, if there are anything you want me to share my thought on, you can put it as well there. Let me bring back my screen and let's jump into the discussion quickly. Chinenye Miriam also with a thumbs up in the chat. Thank you. So now that we've spoken about these issues, let's take them one after the other and share our thoughts on them, starting with the basic earnings per share. So we're going to start with basic earnings per share, but we're going to take the items one after the other and then talk about them. Remember, again, if we should go back, we said under basic earnings per share, there are three scenarios that we have to pay attention to: the issue at full market price, bonus issue, and right issue. So we're going to take them one after the other and then talk about them. So let's see. Number one, issue of share at full market price. That is the first scenario. This is where an entity issues shares during the year it's a public issue to all shareholders. It means that existing shareholders and new shareholders can also buy the shares. Okay. So this refers to the issue of new shares during the year. During the year. You must note that these shares can be subscribed to by both existing shareholders and new shareholders. So, in other words, it's a new issue to the public generally. That's what we are trying to say. It's a new issue to the public. Everybody can subscribe to it. Everybody can subscribe to it. It's a new share we are issuing to the public. In this scenario, when there is this like that, how then do we calculate the earnings per share? Pretty simple. The earnings per share is going to be, like we said, PATS, profit attributable to equity shareholders, divided by the weighted average number of equity shares. The beauty of this is that with a PATS, it'll be given in the question. Okay, so as given in the question, you don't have to do anything to it. You're just going to pick what is given in the question and then boom, you are gone. But the weighted average number of equity shares, you have to calculate it. So to be calculated, you have to calculate it. So the weighted average number of equity shares will be calculated or must be calculated by the entity. Okay, must be calculated by the entity. Must be calculated by, as we are doing the workings. So how do we go about that? Very important, very important. It means that our weighted average number of equity shares will be equal to the outstanding shares multiplied by x over 12. I'm going to explain that to you, don't worry. Plus total shares also multiplied by x over 12. Remember, I told you something in the introduction. Let's go back. Here. I told you that when you're calculating the weighted average number of equity shares, there are two things that you have to take into consideration: the number of periods of outstanding shares and the bonus issue. And I told you that bonus issue will rise or will come up when we are dealing with bonus fraction. We have to deal with bonus fraction, and bonus fraction will come up when we are dealing with bonus issue and right issue. So in the context of this question, what we are doing here is that when we are calculating the wins, we have to calculate the wins based on the shares before the issue. So what you see on the left is the shares before the issue, and what you see on the right is based on the shares after the issue. Okay, the shares before the issue. How long has that been in the business? How long has that been with the organization or for the year? And then we'll be able to do a calculation for the period in that case. So let's crunch some numbers. And let's bring it straight up into it. So for those of you with the book, you're going to have this question in the book. So there's no need for you to write it up. If you don't have the book, you can take a screenshot of the question as I try to, drop it in my slide. There we go. So the first question: My Love Limited had 10,000 2.5 shares at the beginning of the year. Stay with me carefully. At the beginning of the year, it issued 4,000 shares at $4.5 per share on 1st March 2020. 1st March 2020. Calculate the earnings per share if the profit for the year ended 31st October 2020 is $100,000. Is $100,000. So, what do? Let's go. My Love Limited. Now, the year ended of the company is very important. Remember, I've told you about this throughout the IFRS masterclass that any calculation we are doing, we have to do it around the year ended. So any standard, all the standards, year ended is going to be very important. So the year ended is 31st October. So it means the year starts on 1st of November. So the question you have to ask yourself is, from 1st November 2019, which is the beginning of the year, the entity had certain outstanding shares. Now, remember, they made a issue on 1st March. So it means from 1st November 2019 to 28th February 2020, they were having an outstanding shares of what was given in the question to be 10,000. Now, remember, when you're doing this, the value at which the share was issued, we don't consider it. You only consider the value at which the shares were issued when you're dealing with right issue. When you're dealing with right issue, apart from that, the amount at which the share is valued, we don't deal with it. We don't care about it in the context of earnings per share. But when we are dealing with the right issue, we're going to be using that. But when we get there, I'll explain that to you as well. So November, December, January, and February. So if you realize, this has been there for 4 months, because from 1st November 2019 to 28th February 2020, it's 4 months. Then from 1st March 2020 to the year ended 31st October 2020, how long is that? That's going to be 8 ultimately, because March, April, May, June, July, August, September, October. So that is 8 months. So for the rest of the 8 months there, our outstanding shares will be the shares that were there before the issue, 10,000, plus the new issue that was made, 4,000, giving us a total of 14,000. I hope you are following the treatment. Giving us a total of 14,000. That's very, very important. Now, how then do we calculate the weighted average number of equity shares? Remember, like we said, when you are calculating the weighted average number of equity shares, you are going to be taking the outstanding share, the number of period, the total shares, the number of periods. So let's go. So our weighted average number of equity shares, and I'm going to tell you a story in a moment, so stay with me, will be the first part, 10,000 times 4/12, plus the second scenario, 14,000 times 8/12. So we punch that out, and that should give us 12,666. That is our weighted average number of equity shares. 12,666. The final answer, 12,666. You can punch that out as well individually. So that is how we calculate the earnings per share. Now, the weighted average number of equity per shares. The weighted average number of equity shares. Now, why are we calculating this? You see, even though at the end of the year, 31st October, there are 14,000 shares, the principle behind the weighted average number of equity shares is that not all the 14,000 shares qualify for dividend. Not all of them qualify for equal dividend, because somebody was there on 1st November and has been holding the shares from 1st November to 31st October. Then you just came in 1st March 2020, and you've bought the shares, and you are also from 1st March 2020 to 31st October 2020. Do you think all of you should receive the same amount of earnings per share? The answer is no. Are you getting the rationale? So that is why we will always calculate the weighted average number of equity shares, because even though there are 14,000 shares at the end of the year, as at the reporting date, that is what will go to the statement of financial position. Not all those shares qualify for equal earnings per share. For that reason, we have to then calculate the weighted average number of equity shares. So based on this premise, basic earnings per share, basic earnings per share would then be equal to the profit, which is the $100,000, divided by 2,666, and that will give us our answer. That will give us our answer for the period under review. So let's punch that out. 100,000 divided by 12,666, and that is 7 point maybe 90 dollars, $7.90. But you see, sometimes it is prudent to leave the earnings per share in the smallest unit of the currency. So we will multiply it by $100. If you're in Ghana, 100 Ghana cedi, okay, whatever it is. But we multiply it by 100. When you multiply it by 100, it means your answer can become 790 cents, the smallest unit of the currency. Please, we are not multiplying by 100%. We are multiplying by 100 Ghana cedi, 100 pound, 100 euros, $100, 100 naira, 100 whatever the heck currency we are using, so that we can get our answer in the smallest unit of the currency. So that is why we will multiply by 100, so we can get an answer in the smallest unit of the currency. And that is the first scenario: issue at full market price. Issue at full market price. You realize that, I mean, there is no miracle here, there is no strange things here. All you have to know is how long it has been, the period, then you'll be able to know exactly what it is that you have to do. That is the first thing: issue at full market price. Issue at full market price. Any questions, please? I see some of you guys joining. You are welcome. This is our IFRS masterclass, and we are in earnings per share, and we are looking at a couple of things about it. I see some questions coming in. Let's see if I can take them quickly. How often this direct lecture comes a week, and what topics will you cover in Rwanda? There is many people who want these courses. I share the link. Okay, that's great to hear. You can subscribe to the channel and stay connected, or follow us on Instagram for our lecture updates on our YouTube lectures. But if you want to get access to our full courses and also join our live Zoom sessions, that also you can enroll in our full courses on our online portal at nhyirapremium.com, or download our mobile application on the Google Play Store or the App Store, and you'll be able to get access to our courses as well. If there are any other enquiries, you can also call the number below the screen: 050-114-9296, 050-114-9296. Ibrahim said, "Hi, Nhyira, I'm just coming." Okay, Ibrahim, you are welcome. John Bauer said, "Please, do we still use same formula for basic earnings per share, even if it is a net loss?" Yes, if the company makes a loss, it's the same scenario that is going to be coming in that regard. It means our answer will just be a negative answer coming in that regard. Our answer will be a negative answer coming. So usually, if the entity makes a loss, it will still be calculated, but our answer will be negative. Okay, our answer will be negative. Jamil Imoru said, "Nice to be back." Awesome, Jamiru. Thanks for joining us. Jamil, sorry, thanks for joining us. Then who do we have here? Shelly. Look at me. I'm saying Shilly. Akwawe Abon. Shelly Ann Bailey, thanks for joining us on the stream. And the emoji there, Shelly. Ibrahim said, I think I missed a lot. Yeah, definitely. But you can watch the playback after the stream, because after the stream, the uh, lecture will be available on YouTube and you can watch the playback to be able to follow through. Any other questions? I see some of you guys joining. Welcome. Give us a thumbs up on the video. Really helps us a lot. And share the video. Let's reach as many students as possible. You ready? Let's go to the second scenario. And that is going to be bonus issue. Bonus issue. So when there is bonus issue, what are we going to do? How are we going to do it? So let's look at it. Bonus issue. Bonus issue. Now, someone may ask, what is a bonus issue? What is bonus issue generally? Now, bonus issue is simply the issue of free shares to the existing shareholders, period. Okay? It refers to the issue of free shares to existing shareholders. Period. Keyword, free shares. So you get additional shares for paying nothing. Why is this so? Because it happens when an entity is trying to convert reserves into stated capital. Okay? So it occurs, or it is when the entity is converting reserves into stated capital. Or instead of paying shareholders dividend, we give them shares, period. Instead of giving them dividend, we give them shares. So we are converting reserves into share capital. Now, for instance, in the banking sector cleanup fiasco thing that occurred, generally, what happened is that many of the banks did not necessarily inject additional fund into their business, because what happened is that they were having a lot of retained earnings, they were having revaluation surplus, they were having a lot of things in that regard. So we have retained earnings, we have revaluation surplus, we have other components of equity. So if we have these reserves, all they did was to change it into share capital with approval from the central bank, and boom, they're able to meet the minimum capital requirement and exceed the minimum capital requirement. So that is the idea about bonus issue. Existing shareholders are getting more shares, but they are not paying anything for it. They are not paying anything for it. I hope you are getting the concept here. But this is where you have to be careful, because if you remember in our introduction, I told you that when calculating the weighted average number of equity shares, you have to take into consideration two things: the number of periods of the outstanding shares, and two, the bonus fraction. And I told you that the bonus fraction will come up if we are dealing with bonus issue and right issue. We are in bonus issue, it means bonus fraction is going to come to town. So, under the bonus issue, how do we calculate our basic earnings per share? So our basic earnings per share still PATES, profit attributable to equity shareholders, divided by the wins. Again, here, you don't do anything to the numerator, so it's given to us. But then to be calculated, we have to calculate the wins. Sounds good? To be calculated. To be calculated. Now, stay with me very carefully here. In calculating the weighted average number of equity shares, there has to be a bonus fraction. Why is this important? Because you see, they are not paying anything for it. So you are giving them free shares. If you are giving them free shares, then we would have to take into consideration that when it comes to the issue relating to it. So, how do we calculate the bonus fraction here? The bonus fraction is going to be equal to the number of shares after the issue divided by the number of shares before issue. That's how you calculate your bonus fraction. Please stay with me carefully here. And I want you to understand that I'm going to explain how you calculate that. The bonus fraction affects only shares outstanding prior to the right issue. The bonus fraction, BF for bonus fraction, affects only shares outstanding prior to the right issue. Prior to the bonus issue, sorry. Because this is still in right issue, so prior to the bonus issue. So our bonus fraction would just affect shares before the bonus issue. I'm going to explain that to you also in a moment. So when we say bonus fraction should be number of shares after the issue divided by number of shares before the issue, what exactly are we driving at? And what are we trying to say generally in this context? So let me go back to my slide and let me show you what we mean by that with an example. Please stay with me carefully. I have two examples here, and I'm going to use that in the slide to show you what we mean by bonus fraction calculation. So example number one. If an entity makes a 2-for-5 bonus issue, so listen carefully. The entity makes 2-for-5 bonus issue. 2-for-5 bonus issue. So if an entity makes a 2-for-5 bonus issue, what does that mean? It means that the entity gives 2 new shares to shareholders in proportion of 5 shares already outstanding. So if you have 5, we give you 2 new shares, 2 for 5. What does that mean? It means after the issue, you now own 7 shares. So if we are calculating our bonus fraction, it is going to be the shares you are now owning after the issue, which is 7, divided by the shares you were owning before the issue, which is 5. So our bonus fraction becomes 7/5 in the context of this question, 2-for-5. I hope you are following the picture. Second scenario. If an entity makes a 1-for-4 bonus issue, if an entity makes a 1-for-4 bonus issue, what does that mean? It means we give you 1 new share for every 4 you are having already. And so in the context of that, it means your bonus fraction will be equal to 5 divided by 4. That is how we calculate the bonus fraction. That is how we calculate the bonus fraction. Very sweet, simple, straight to the point. So that's the concept about bonus issue. We are issuing new shares to existing shareholders at no cost to them. It's a free shares. Why are we doing that? Because we are converting reserves from retained earnings, revaluation surplus, other components of equity into share capital. For that reason, we have to calculate a bonus fraction. Note that usually, if the bonus issue occurs at the beginning of the year, then our weighted average number of equity shares would just be, the number of shares outstanding plus the bonus issue of shares. So where the bonus issue occurs at the start of the year, or the bonus issue occurs at the start of the year, our weighted average number of equity shares will be equal to the outstanding shares plus the bonus issue. Here, you don't do any timing ratio, any number of period, because It's just occurring at the beginning of the year. But if it doesn't occur at the beginning of the year, then we have to go by the default issue that we mentioned here about weighted average number of equity shares, taking into consideration the timing ratio and taking into consideration the bonus fraction. Okay. Any questions, you put it in the chat for us or the comment section for us. Let's crunch some numbers and make sense of the principle. Let's crunch some numbers and make sense of the principle. So let's see a pretty example here, pretty simple example here. Again, I'm using these examples because they are baby examples to help us understand the principles, because we're going to be putting them together later on in a more complex question, and you're going to see how we're going to be dealing with that later. So let's see. Calculate the earnings per share for the year ended 31st September 2020. So what we got? Let's see what we got. OMG Limited has the following information. Profit after tax, $400,000. Outstanding shares, into bracket $1 is 40,000. Now you have to be careful about it, because if, for instance, the into bracket is 0.5, then you have to calculate the number of shares outstanding. Did you hear that? Then you have to calculate the number of shares outstanding. That's very, very important. That's very, very important, because the number of shares outstanding will be, in the context of this question, because it's one, it's going to be the same thing. So it's going to be 40,000 divided by $1, and so it's going to be 40,000 shares. But assuming it was 0.5 or 0.75, then the computation is going to be a little bit different, because we will divide the 40,000 by 0.5 or 0.75 to get our number of shares. So be mindful of the nominal value. This is called the nominal value of the shares. The nominal value of the shares, the value at which the share is carried on the face of the statement of financial position. So we have to be mindful of that. Okay. Then it says, on 1st April 2020, the entity made a bonus issue of 2-for-1. All right, so let's see what the heck is going on here for the period under review. Now, if the year is ending on 31st September, that means the year starts when? 1st October. So what are we going to have? On 1st October 2019 to 31st March 2020, that's going to be how many months? October, November, December, January, February, March. That's 6 months. So for that 6 months, our outstanding shares was the 40,000. Sounds good? The 40,000 shares. Then we are told that they issue shares. So from 1st April 2020 to 31st September, also 2020, another 6 months. The outstanding shares will now be, or if you want the total shares, will now be the 40,000 that was having plus the bonus issue. Now, how do we get a bonus issue here? They said 2 for 5. 2 for 5. Did I say 2 for 5? Sorry, 2 for 3. 2 for 3. So we give you 2 new for every 3 that you are having already. So that is going to be 2 over 3 times 40,000. So we can punch that out to get our answer. Let me adjust my slide a little bit to make some space. So what do we have there? Let's see. We'll have 26,667 so that our total shares from April to 31st September will be 67,667. I hope you are getting the picture well. Now, because it is a bonus issue, we then have to calculate the bonus fraction. The bonus fraction. If you remember, we said bonus fraction should be the number of shares after the issue divided by the number of shares before the issue. So what do we have here? Before the issue, we had 3. After the issue, we will have 5. So our bonus fraction will now become 5/3. Now, you don't punch it out to get any answer for the period under review. So it's just going to be left there like that because we will use it to do our calculation. So let's present our, answers up for the weighted average number of equity shares. Remember, I told you that the bonus fraction affects shares only prior to the right issue. Affect shares only prior to the right issue. So we're going to be putting periods here. We'll put the outstanding shares here. We're going to be putting bonus fraction here. We're going to have our timing ratio here. Okay, 66,667. So timing ratio here. Then we're going to have the average in the last column. So period, we've already established the period, 1st October 2019 to 31st March 2020. So 1st October 19 to 31st March 2020. We had 40,000 shares. The bonus fraction will affect those shares, 5/3. The timing ratio is 6/12. Then from 1st April 2020 to 31st September 2020, we now have 66,667. The bonus fraction will not come again. Why? Because I said that the bonus fraction affects only the shares outstanding prior to the right issue. So after the issue, the 66,667 will not affect the bonus fraction. The bonus fraction will not have any effect on that, but our timing ratio 6/12 will come in. Are you following? That is the principle, that is the meaning of the statement we made here, that the bonus fraction affects only shares prior to the right issue. The bonus fraction affects only shares prior to the right issue. So let's punch that out. And this is 3,3,3,3. And then we will have 3,3,3,4. So our wins will now be equal to 66,667. 66,667. So once we have our wins, we can now calculate the basic earnings per share. So basic earnings per share will be equal to our profit attributable to equity shareholders, $400,000, divided by the wins, 66,667. Certainly, we will be able to then get our answer, 400,000 divided by 66,667. That's $5.99 approximately around $6 if we want to, just $6.0 because 5.99, maybe $6.0. But remember, we can multiply it by $100 so that we can get the answer in cents. Then it becomes 600 cents, something like that. in the smallest unit of the currency. That is how we deal with bonus issue. That is how we deal with bonus issue. So if there